And today we're going to kind of give a market update. We're here in the summertime of 2025. We're going to cover some real estate data that we see out there. Figure share with the audience on help you make the best decisions for your purchasing and selling and renting of real estate. Paul, I got my screen shared here. Let's start off with a good chart here just on median home price and inventory. So the red line is median price. The green bars call it our like inventory, and it's going back to all the way up here to today. Start with the median price, right? That's continued to trend along. You know, had the huge spikes a few years ago in 2020, 21, 22, and then since then we've kind of had slower increases. Again, this is national picture, and you know, obviously you're seeing different price points, and we'll get into other articles across the nation where you know some areas are continuing higher than this, and some areas are going much lower and decreasing in this. And then the other thing to jump off if too is the inventory continue to grow, basically. Again, it varies by market on how much the inventory level are, but we're starting now to get back to that, call it pre-2020 level of housing inventory, which is good for home buyers. They have more to choose from, and it's going to put pressure on pricing in certain markets too with too much inventory. Any thoughts there, Paul, on anything else?
Yeah. No, I mean, that's all good. We obviously wanted it to trend upwards because we're still not at a normal, healthy inventory
Yeah.
environment here. So, things have been hard for buyers. If you think about it from a buyer's perspective, there wasn't a whole lot of inventory. Prices were getting run up so much that what you had was people being priced out of the market. So prices had to plateau and balance out. They're still going up year over year, right? And our rates are slightly down, like 0.1% year over year to 6.8% on average. But home sales are up 3.3%, which is a positive, and that's probably from the uptick in inventory. And there's deals in certain markets, Mike. We're attacking markets where there's really good deals out there, and we're finding some arbitrage out there. So there is opportunities out there from both a buyer's perspective and a real estate investor's perspective. So
Yeah.
all good things here.
And to add more context on this chart, if we were to add back 18 and 19, 2018 and 19, the green here essentially would be around 1 million, 1.1 million, if I remember correctly from other charts.
Right.
So it's still not back to what it was, call it 7, 8 years ago. The next one is a good snapshot of a bunch of different facts here. Let's take a look. You got 10-year yield over the last 90 days, kind of trading sideways, right? It goes up, goes down, comes back. And we've been in that pattern. Mortgage rates, right? It's kind of up and down, but we kind of been, if you zoom out even more, you're in a trading range essentially. We've been in the high 6s, low 7s for like a year now, probably easily, or maybe more. Inventory, we talked about that. This is just a 90-day look. It's been trending up. Median price, we just talked about that as well. Price reduction is the one that sticks out to me, and we've been seeing it through our properties for the last 12 months now, where price reductions are happening and or every house wants a seller assist too. It seems like just because it will help with the closing costs of the property. Folks are cash strapped to buy a property. They might meet you at your asking price, but then at the end of the day, you're going to have to offer a seller assist as well. Anything to add there, Paul?
Yeah, I mean, that's key. That's a normal market where you're going to get something that people are asking for seller assist, right? We were in that hyperbolic market where there was no inventory and everybody had to go above asking price, waive all contingencies. And that's not great for buyers, right? Because that's just a lot tougher, a lot more money you have to come to the table with. So we're in more of a normal market. When we're looking at properties, Mike, we price in now a seller assist. We price in sometimes a home warranty and other factors and a little bit longer hold time, right? Because price decreases are more common now. And days on the market are up a bit. So that's going to continue. The more inventory you have, the more days on the market you're going to have, and the more price decreases you'll have, naturally with more competition out there.
Yep. All right, let's shift gears now to this article. 10 slowest housing markets in the U.S. I'm just going to show the map. Any surprises, Paul? We buy nationally, so it's does this feel right?
It feels totally right. And so you got 2, 3.
The only one that does it to me is number 6, Ohio.
Yeah, that's odd. We've done well in Ohio,
Yeah.
but maybe it's just certain markets that are slower there for whatever reason.
We'll scroll through the article. I haven't read it yet entirely, but I just think this is a thing we just saw before our video here, so I figured I'd pull it up. I thought it was a good chart, or map, I should say. But it felt right for the most part, except for Ohio.
Yeah. No, I would agree 100%. But you look at the 2, 3, and 4 And you got Florida and Arizona. If you think about this, I've talked with a few people, since a lot of companies were virtual, you could live wherever you wanted. So a lot of people went to the Sun Belt, whether it's Florida or Arizona, like retirement areas, right? Nicer areas. But once you're called back to work, now these people have to move. So maybe they're selling their properties and moving back to where they were originally so they can keep their job. So I think those markets might have been hit a bit by that. And obviously there's other factors in other states too, but Ohio is the one that is surprising us. And same with, was that Tennessee as well?
Yeah.
I'm surprised one as well.
Yeah. We don't do too much in Tennessee, but yeah, I'm
Right.
surprised there. Let's see if they have any context here.
Miami was overpriced. That makes a lot of sense, right? It just came so
Yeah.
overpriced. Orlando as well.
Yep.
And the market turns in Orlando. Orlando is a destination spot for vacations, right? So as the market turns, as the economy tightens, as people's paychecks are a little bit tighter and you don't have as much money to do anything, Orlando's going to be hit really quick. Las Vegas will be hit really quick, right? Those things.
Yeah. They call it the Columbus market in
Okay.
Ohio.
Yeah. That one grew like crazy, Columbus, Ohio. And you see Vegas was one of them in there. So just a lot of it makes sense.
Yeah.
Tampa.
Okay. They spike out the cities down here. Yeah.
Yeah, I like that. Raleigh, North Carolina. Let's actually talk about that one for a second because that's an interesting one and bells went off in my head. Raleigh, North Carolina is a big time tech hub, just like Denver became at with AI eating into these people's jobs. That's softening that market, right? That could really soften that market because there's a lot of developers right now getting laid off because AI is eating a lot of the coding jobs and a lot of these developing jobs out there. That makes a lot of sense as well. Interesting. Because Raleigh was a
Yeah.
hot market.
Yeah. The other ones pretty much don't surprise me. Especially all the Florida ones. We've
Yeah.
covered that. You live in that state, so you're well versed in the inventory issue right there right now.
And there's opportunity, Mike. Let's talk about the last deal we just got there in Florida, where it was listed at 365, and I think went down to 300. We got it under contract for 179. This is a HUD deal, right? That's a
Yep.
nice margin. So
Yeah.
where you have all these properties listed, they're now going to have bigger margins, discounts that you're going to be able to get.
Yeah, certain areas might have bottomed already, right? And people are just trying to get big stuff.
Yes.
And you still got to be cautious.
Yep.
I think on that one, we even assumed on a wholesale deal it would take 9 months to close, basically.
Yes.
So it's we're adding in the financing costs and the holding costs and all that stuff just to be cautious in some of these Florida markets because I feel like some areas, and even talking to you, right? You're down there, right? They're close to the bottom, call it, right? It can't go much lower type of thing.
Exactly.
Hopefully you'll be able to start picking up some good value opportunities in those markets.
I think so. I think that's where we're going to be really getting the best deals at this point.
Yeah. Oh, they explain the Nashville and Raleigh here. Why are homes staying unsold?
Spiking construction.
Metros like Nashville and Raleigh, they built more new homes during and after the pandemic. So it's almost like they overswung on their construction.
Overbuilt. Yeah,
Um,
overbuilt.
And then, it's basically the Northeast in general, right? The inventory has been low in the Northeast. There's nowhere really to build more in these cities, right? We've been around for 300 years, and you saw little new construction in these periods, and that's why you're not seeing those market rates decline because the excess inventory, you can't build anymore.
Yeah. And Boston, that market, my brother-in-law lives up there, and he just recently bought a new property. And it's the same. They're going through bidding wars and all these things still because there's just no inventory, right? So that's an example of complete opposite where it's hard to get the good deals.
Yeah, and just more data on the markets, basically. A median list price. Yeah, nothing new here, just more data. And then the last one I was going to end with is good news. We went just to the facts. We want a little bit of bad news. Now let's talk about a little good news. Blackstone, Masters of the Universe Private Equity here. It's buying rental homes in the U.S. and they got a video on CNBC if you want to listen to more. And this asset manager, they buy up a lot of residential real estate. And here's a good map here that kind of shows their breakdown. Baby blue is multifamily, yellow is single fam, mobile homes even, and then student housing. And here's the dots on the map on where everything is and where they're buying. And they're all over. I mean, primarily not surprising given just average populations, but where they're at. But it's a good indication where if you're in these markets, right, and you got a big asset manager in there, that helps. Again, they're still a small piece of the overall purchasing of real estate and transactions, but they are one of the biggest buyers in the country. So kind of a peek into what they value. essentially.
Look at all the single family that they're buying in Texas too. That's interesting. Texas, Georgia seem to have the most single family markets that they're in. So they're bullish, very bullish long term in those markets for
Yeah.
sure. Mobile homes make sense.
And another
Florida,
thing is,
Carolina.
right? We just talked about Raleigh. Again, I don't know where in the state you're talking, but they just
Yes.
talked about Nashville and Raleigh. Are those two cities? I mean, I can't pinpoint the exact locations. Might be Charlotte,
Right.
but it's just interesting to see, where Blackstone's continue to acquire properties into their portfolio.
Yeah. It's bullish for investors, right? Because even with mortgage rates still elevated more than they've been over the past few years, that they're still buying, right?
Yeah.
That's a great sign for the market, for the economy, that they think the economy is going to be solid enough that they're going to hold these for a period of time, 5 years, maybe 10 years, and sell them.
Any other things that you're seeing in the marketplace, Paul?
No, as long if let's talk mortgage rates because they're always the key factor, right? If you drop down 0.5%, how many more millions of buyers come in? We've seen this. I think when it got to 5.5%, it was an insane amount of buyers.
I forgot who I got it from, but it was like at one point, if you went from, I'm going to make up a number here, but if you went up 50 basis points or down 50 basis points, like 18 more million people could now afford that 30-year payment. So each 50 basis point swing is millions and millions of people. You're entering into their price point essentially.
Let's forward think, just because I'm thinking of what the Federal Reserve may do, because Trump administration is really pushing them to lower rates, and if they do get in there and start doing that lowering of rates, I think we're going to see a more favorable mortgage rate coming from the 10-year Treasury as well too. There's a couple of different factors I like on the 10-year Treasury. That, and let's get into digital currencies and crypto with the stablecoin act passing. One of the biggest things these stablecoins will be buying is treasuries. So they'll be buying up treasuries to backstop their stablecoin. And that's their biggest holdings that they're going to end up having there. They're going to have treasuries. They're going to have real estate as well, both commercial and residential real estate. Again, another bullish thing for real estate. So this could push rates down. So if you're thinking over the next couple of years, we're still hopeful that rates are going to go down. We don't know if they will, but if those things start going, if they start cutting rates, that's going to spur real estate again. If it's spurred too much, that becomes so hot that prices start to go up dramatically again too, because that's still about, we're at that affordability factor right now where so many in Gen Z can't afford to buy a house, right? We went from a median age a decade ago of buying a house at 28. Now we're at 38 years old. 10 years later, this can't sustain, right? That can't be when you're first buying a house, 38 years old. We need to get that back closer to that 28 year if we can.
Yeah, an ideal situation on average, right, for people is you kind of take a pause on home price increase and call it 0 to 1% a year for a few years, and then rates are actually able to drop because then the values are stable. They're not going up a lot, but rates come down. So then now to figure out your monthly payment, it's a lot more affordable for people. So see what happens. To your point, stable coins, if they have to buy 10-year treasuries, right, that drives down yield pricing because you have more buyers to buy that product. Mortgages are kind of quasi connected to that.
And it's a global market. These stablecoin companies are all over the world. And if they're going to have the backstop to be important to be in the U.S. market, right, they're going to have the backstop with U.S. treasuries, which was brilliant by the Trump administration to basically stabilize the dollar. This should help stabilize the dollar more and make the dollar a little bit more valuable because it's been on a decline, but now hopefully this can help it rebound over the next 6 to 12 months and really at the same time hopefully help mortgage rates down as one other method to help reduce mortgage rates. And hopefully the Federal Reserve eases off because they're at the point where they really need to, and I think they know what's coming here because look, AI is going to put more pressure on jobs, and that has nothing to do with the stable market. That is just technology disrupting jobs, right?
Yeah.
So there's a lot of factors coming into play here. But positive times, I think like we're still bullish and we're trying to get things at better pricing. I know a lot of investors are sitting on the sidelines and they probably shouldn't be. They probably shouldn't be at this point. This is a point where you want to be not overly aggressive, but smart and tactical about where you're looking to buy.
That's right. Absolutely.
I appreciate it, Mike. This was a good talk here, and we'll catch everybody.
Absolutely. See ya.
We'll catch everybody in the next one. See ya.